the listeners who have lost out in previous talks on Economic Chat Let's Talk Business, you can of course go to economist.com.na and catch up, because we have reached week 99. So that means you need a lot of catch up to do. Right, Mr. Daniel Steinman?
Elsie, have I really endured you for 99 weeks?
Well, I could ask the same question, but I can actually say that I've learned a lot. Yeah, so hopefully, and I believe that the listeners have also learned a lot from this talk.
It's around the corner to 100 weeks.
100, imagine that.
Unbelievable.
We need to do a celebration.
Yes.
But before we do that, before we went on a short break, you have said that you will elaborate more on
the central bank's role, the interest rates locally
of the US,
and
yeah.
the US. Yeah. But let's just make one point very, very clear. The Bank of Namibia deals with the future. And you remember what I said, you have to be very modest when you deal with the future, because you work with certain assumptions.
Yeah.
And your modeling may hold good or it may not hold good. You know, you can come, it's like a budget.
Yeah.
You never on target 100% to the cent in a budget. You're always above or below. The big question is how far above or how far below.
Yeah.
And it's the same with the type of future views that the central bank adopts. It's based on certain assumptions, and it's never a smack dot bull's eye. It's always sort of ballpark, you know. It may go this way, it may go that way. And remember, I said I think our interest rates are too high. If you look at the the intrinsic economic values in our local economy, we can easily do with lower interest rates. And I'm talking a good 2 percentage points lower. I'm propagating that the Namibian economy will not be harmed by interest rates in the region of about 5.5% instead of 7.75%. So why is it that we cannot bring the interest rates down? You know, but you need to confirm to me. It's very clear. The Statistics Agency, they work with empirical fact, historical, it's proven, it's easy to measure. The Bank of Namibia, they work with the future. Difficult to predict 100% correctly, impossible to predict 100% correctly. So one has to be sensitive about this, and you also have to keep that in mind whenever you make a judgment about the validity of the view that they take to determine interest rates.
Yeah.
When I say that I believe we need lower interest rates, it's a personal opinion. When they say we have to maintain the interest rates above 7%, it is based on the reality that's more or less where South African interest rates are. We are close to them. But it is determined by what happens in the United States. Now, if you look at the US market, you've got certain so-called short-term interest rates. This is what is determined by the Federal Reserve, the same as our repo rate. It has a bearing on anything from any loan or any credit facility from 1 month to about 3 or 4 years. Then you also have long-term interest rates, for which they use more than one indicator, but the most popular or the most widely quoted is the so-called 10-year US Treasury bond. That is long-term interest rates. That is not determined by the Federal Reserve. That is determined by the market. In other words, what investors are prepared to pay for US government bonds, or what they're not prepared to pay for government bonds. And you will often see, especially if you look at or listen to an analyst with a little bit more savvy, they are sensitive to the fact that long-term interest rates, 10-year interest rates, are determined by the market. In other words, by the willingness of investors to buy the bonds, or at what level they are willing to buy the bonds. And that is a function of risk. Now, I see you pulling big eyes. Why? How can you say it's a function of risk? It means, in a very fundamental way, the investors, the fund managers, they ask themselves, if the American government were to default, what do we stand to lose? Or how much must we be compensated to accept that risk, that there's this small possibility that the US government can actually default? And it's not so it's not really unthinkable. Every 3 or 4 years we get this big noise from Capitol Hill that the American government is going to run into a liquidity crunch and they
Shut
can't
down.
agree to increase the levels and
Yeah.
and the whole government's going to come to a standstill. And you and I know that this is all a political game,
Of course.
but it's got a very big impact on the capital market, meaning the willingness of investors to buy bonds, and that has got a very big impact on short-term interest rates. Now, because the American economy determines the economy of the West, it means that if they adjust the interest rates either up or down, that creates room for the South African government to either up or down
Yeah.
the interest rates. And the reason or the mechanism is the exchange rate. And I am going to expound that a little bit. Why is the exchange rate so important? Why is it determined by US interest rates? And why is it so important for South African interest rates and by implication for Namibian interest rates?
Okay. We will quickly go for a short break. Once we come back, all those questions will be answered.